Hello people, in today's video I'm going to break down how the rich hoard properties and grow a massive property portfolio. It all centres around buy-to-let properties and using the same pot of money and recycling out of every single deal and into the next one. Hi guys, I'm Jim, welcome to the channel. In today's video I'm going to break down the BRRR method. Someone say BRRR? Is it really cold in here? No, I'm only joking. BRRR stands for buy, refurb, refinance and rent, and it's how the wealthy grow massive property portfolios, so it's definitely worth us all sitting up and taking notes. So it all starts with B, which stands for buy. Now you're looking for buy-to-let properties which need value adding to them. So a value add comes in the form of a refurb. So when you're looking on Rightmove or speaking to agents, you need to make sure they understand that you're looking for a property that might be in a sorry state of repairs that you can add lots of value through a refurb. Now typically this might be under 100,000, maybe up to £150,000 if you're going to a more family friendly area. But the key thing to remember when you're looking for locations is those back end values. You need some comparables in terms of other people selling properties at that price or refinancing at that price. You also want to look for areas with strong rental demand because the last step in this model is to rent, of course. So now you're looking for properties where you need to add value to them. There's three ways you can purchase them. There's cash, there's bridging loans, and there's of course a mortgage. Now the first two are probably the best ways to do this model, as being a cash purchaser means you can act quickly, and definitely in today's market where things change really quickly, this is a massive advantage. Unless you're absolutely minted and you're sitting on a massive war chest to go and purchase properties, it's probably unlikely that you've got all the cash to buy one of these deals outright and pay for the refurb. However, you can use other people's money and lend from other investors and give them a fixed rate of return. The key thing to remember with this is when you're running your numbers to make sure you factor in the cost of finance. Bridging loans are similar to this. Bridging loans are just really short-term loans for probably a maximum of 6 months where you can lend from a bridging company, purchase the property and do the refurb and then refinance it after 6 months. However, some of these interest rates do vary, so it's definitely worth speaking to a broker who can get you the best deal. And also, you need to factor in these costs when you're running your numbers. Now, the last way to purchase property is via a mortgage. This is definitely the slowest way and it can take a couple of weeks, if not months, to purchase the property this way. The important thing to remember about doing this model with a mortgage is you normally have to wait 6 months before you can refinance out of the deal. This was imposed by the Council of Mortgage Lenders to stop people from refinancing money out on the same day, because back in 2008, you could purchase a property for say £70,000, refinance it on the same day for £100,000 and take £30,000 out. So now most lenders don't let you refinance until after 6 months, so it's worth factoring this into your costs when you run your numbers. Normally this model is probably best to use in Northern England, but you can do this anywhere. You just need to make sure you purchase the property at the right price, you manage your costs on your refurb, and you have the back end values at the end. So the next step in the BRRR model is the refurb. Now this is something that I've spoken about a lot in property. This is the key part of the process. This is where you actually add value to the property, and you want to make it somewhere which is really nice to live for people to potentially rent down the line. At this stage, it's good to see what's on the rental market and the sort of spec they have, because if you want to push for a ceiling price, you might have to go in above and beyond in terms of the cost on your refurb. But there's definitely a sweet spot in terms of rental income and the amount you spend on your refurb. So you need to make sure you factor this in when you're doing your due diligence. You probably want to spend anywhere between £5,000 and £20,000 on this refurb. And a rough rule of thumb is every pound you spend, you want to add £3 worth of value. Now at this stage, it's probably worth getting a builder involved if this is your first project, because they'll be able to give you a more detailed spec of how much stuff is going to cost. It's 100% worth having a contingency in your budget. Now this could be 10, 15 or 20%. I'd probably urge for 20% just to make sure it's safe. I'd also factor in a couple of extra months of costs, because things normally overrun when it comes to a refurb. So the next step in the BRRR model is the refinance. Now, if you're using a mortgage, like we stated earlier, you normally have to wait 6 months. But if you're using cash or bridging, you can do this sooner. This involves you getting a mortgage company to come out and revalue the property after the refurb, after you've added the value. At this stage, you should have a higher revalue price. And this is where you can refinance the product and pull 75% of the value out of the property, leaving 25% equity in, which is standard for a buy-to-let. At this stage, you'll probably move on to an interest-only mortgage. We actually made a video about this, which you can check out now. You might speak to some people about the good old days of the BRRR model, where you could pull all your money out and some. You could pull £5,000 out, so you could actually buy a property deal, refurb it, refinance it, and pull money out. Although you can still find these deals, they are very much the exception and not the rule. So most of the time, you need to be prepared to leave some money in the deal. This could be up to £10,000. However, the key thing here is the ROCE, which stands for Return on Capital Employed. Now I'm going to make a separate video about this because this is basically how hard your money is working for you. At this stage we can see how the truly wealthy grow their portfolios, because once they've refinanced their money out, even if they've left some money in, they still have a big chunk of money to go again on the next property deal, and they will continue this model until that money is completely run out. And if you're using a mortgage, you could probably do this a max twice a year with one pot of money. But if you had cash and you were really experienced at refurbs, you might be able to do this a max of 4 times a year with the same pot of money. The final stage of the BRRR model is rent. And this is pretty simple. This basically involves you putting this on the market with a letting agency and renting it out to a tenant. This is where if you've gone above and beyond in your refurb stage, you might be able to push the ceiling price in your area for rental income, which of course, if you're on an interest-only mortgage, will mean you'll get more cash flow every single month. And you could live off that cash flow or invest it into an S&P 500 broad index fund, which could give you an average market return of 10% a year. And that's something I'd probably do, because it's really easy and it's really passive and your money is working really hard for you. So now let's jump into a spreadsheet and look what the numbers could look like on a BRRR deal. So this is a really basic spreadsheet, but it really drills home the point of the model. So as you can see here, we've got a purchase price of £100,000. Fees, which could be your solicitor and other bits and bobs, come to around £3,000. Let's assume your refurb cost is £15,000, which is a pretty decent refurb. So that means you're all in for £118,000. And if you've done your due diligence correctly and you know the back end prices in this area could be £150,000 for a property with a decent refurb, if you revalue that at 75%, you will pull out £112,500, which means you will have left in £5,500, which isn't bad for a property deal in my opinion. And this also means you've got £107,000 to go again on your next property deal. And this is truly how the wealthy build their property portfolios. They use the same pot of money and recycle it every single time. Another good potential way, which is a sort of tweak on this model, is when you get capital appreciation within your properties, is pulling equity out of them and investing them back into properties. And again, this is making your money working even harder for you, because you'll get more capital appreciation from the asset price of the new property, and you'll also get more cash flow each month. And this is back to the fact most wealthy people don't mind having good debt, and this is definitely a mentality shift for most people, because they see debt as a bad thing. However, good debt is not a bad thing. As long as it's working hard for you, growing an asset over the long term and giving you monthly cash flow. This is really important to understand. This is a process I want to take part in myself, and I'm going to document the journey on this channel. So it would really help me out if you guys could subscribe to the channel to follow my journey. And please share with me in the comments if you guys are invested in property at the moment. If not, I'll see you in the next video. Cheers.